All right, let's swing right into the stock market. With us now is Ed Yardeni, president of Yardeni Research. Ed, welcome back. I am still rooting for the Yardeni bull market that started in mid-October. You're still intact. I'm your biggest fan, along with the Kudlow Trust. But here's the thing.
Thank you.
I mentioned this at the beginning of the show, and I've got a chart up on the full screen. This baloney that the Fed should be upset because bond rates have come down and so-called financial conditions are easy, and therefore the Fed should get tighter. This is baloney. And by the way, household borrowing rates have blown sky high, as bad as they were in 2008 and 2009. And the Federal Reserve, if anything, the decline in bond rates is a function of the Fed's success in beating back inflation expectations. So I'm just so annoyed at this financial conditions baloney.
Well, you have to look at the 10-year bond yield relative to the 2-year. When you see that the 10-year bond yield is trading below the 2-year, that's what's called an inverted yield curve, as you know, Larry. And that's actually a sign that the Fed is too tight. So we have a situation where the bond yield has come down because investors have perceived that if the Fed goes much further in raising short-term interest rates, as reflected in the 2-year, something's going to break and there's going to be a credit crunch and a recession. So that's the irony of the situation, is the lower bond yields actually reflect a vote of confidence in the Fed's ability to bring inflation down.
Exactly. Exactly. I mean, you've got, look, Jay Powell's talking about financial condition now. John Williams. Well, John Williams is a very smart man. He's the New York Fed head, vice chair of the FOMC. But this financial condition stuff is just wrong. And furthermore, Ed, I'm just go back to this. The Fed's survey of loan officers, lending standards for commercial loans have tightened substantially. Consumer household borrowing has tightened substantially. And then you got stuff like you mentioned the inverted curve. M2 is plunging. The leading indicators are plunging. I mean, how tight do we want the Fed to be?
Well, look, what we want to do is bring inflation down. We don't really need to have a recession to do that, in my humble opinion here. And I think the Fed has to kind of chill on the idea that we need tighter financial conditions. As you said, a lot of financial conditions are very tight. I mean, the mortgage rate has soared since the beginning of the year. And as a result, we've seen a recession in the housing industry. Retailers have had to discount their merchandise because it's been piling up. The IT industry is laying off workers. So we are seeing some restraint here in the economy. But the important thing is we're seeing moderation in inflation. And Fed officials, including Jay Powell, have acknowledged that there is disinflation. But they make it sound like it's just starting. I think we're actually in a pretty good speed in getting inflation down. And this preoccupation with services, I think we're going to find that too moderates by the second half of the year. So they talk too much. They focus too much on variables that are confusing to most individuals.
You're right. Mortgage loans rates are way up. Credit card rates are way up. I mean, it's not as though they've done nothing. Last 30 seconds, Ed Yardeni. How is the Yardeni bull market dating back to last October? Does it have legs?
Well, I think it does. I mean, it's not going to be straight up. The bear market before the bull market didn't exactly give us screamingly cheap valuation multiples. We get down to 15 on a forward PE basis. Usually in a bear market, you get down to 8 to 10. But I think the economic outlook is better than the consensus had been thinking, and I think that's why we've seen this rally since October 12th. I think we are going to see the market stall out a little bit here because the CPI is coming, and that's going to be creating some nervousness.
All right. Ed Yardeni, terrific stuff. Thanks very much. Talk soon.